Ladies and gentlemen, starting this edition of Live and Breaking with some good news coming in. India's stock market has surpassed Hong Kong's for the first time. Now, that is with the total value of shares that have been listed on Indian exchanges reaching about $4.33 trillion as of Monday's close. That exceeds Hong Kong's $4.29 trillion. Now, this essentially makes India the fourth largest equity market. Now, the stock market capitalization has surpassed $4 trillion on 5th of December, with about half of that coming in the past 4 years. Now, increasingly, as India is being seen as an alternative to China, what does this essentially mean with the kind of promises that have been made by the government too? Remember, the Prime Minister essentially also indicating that the growth story of India is now becoming something, rather a talking point across the globe. Joining us on this broadcast is Republic Business Editor Sharbila Bhowmik, who's going to break it down for our viewers as to what does this essentially mean and how significant it is, as India is largely being seen as the equity market which is growing. Sharbila, put this into perspective in terms of the fact that how exactly are we becoming an alternative in terms of the capital that India is now receiving. The global investors largely looking at India as a booming market. But this news coming in that we have surpassed Hong Kong, what does that essentially mean?
Yes, Shravan, you're quite right out there. India has now totally won the faith of the global investors who have been for a while looking for a China plus one alternative. Now, China's market has been sinking over the past, drawn by their own internal problems, also the lack of faith of the Western markets in them, and the FIIs have been pulling out of the Chinese market, and that portion of the funds have been pouring into the Indian markets for a while, which has been one key reason for the Indian markets rally. Now, clearly, this is only the beginning, and Indian markets are on a very steady foot as an emerging market in South Asia, and globally, as you can see, we are already overtaken Hong Kong, though by a whisker, but the situation is pretty much very strong for Indian equity markets. We are very bullish at this point, and the faith of the foreign investors who are continuously investing back in India again and again shows that as an emerging market, India stands on very strong and firm ground.
Well, in fact, Mr. Sharat Awasthi, Sharbila is also joining us on this broadcast. Mr. Awasthi, thank you very much for joining us. In fact, I'll also ask my colleague Sharbila to also be part of this conversation. As Sharbila has put the base for our viewers to understand what does this mean. What has led to a situation like this where we have seen as a growing equity market, Mr. Awasthi? And more importantly, does that also mean that for China, it becomes far more difficult given the fact that we've seen the kind of regulations that have been brought in by China at this point in time? There is a massive slump that we see in Hong Kong right now. So overall, net in terms of the market, do you see that this is perhaps just the tip of the iceberg?
Yeah, you can say that this is largely the tip of the iceberg, because if you look at the inflows in the last 1 year out of in calendar year 23, out of 4 billion ex-China that Asia received, 2 billion had come into India only. So I think 2 trillion had come into India only out of the 4 trillion. So India inflows are very strong, and China is in a mode where international outflows are happening out of there also. And I think gradually this trend should gather more pace because of the geopolitical tensions that they have with some of the major countries, particularly US. I think gradually there is a shift from China into other countries, and India stands to benefit as a very sweet spot given the strong economic conditions we are into. And the other thing that also adds into is that China's demography of the productive age group is finally going to come down over the next 20-30 years regularly, and it has peaked out. While for India, that peaking out will take another 30 years. So over the next 20-30 years, our productive age group will be among the higher percentile. So that will be a very positive thing for India. And the way the government is channelizing those resources, I think that's also very positive. If we can properly channelize it over the next 5-10 years, I think the 8 to 10 trillion GDP targets that the government is talking about seem like very achievable for India.
Sharad, if I may add to Shravan's question, we would also like to know from you what were the domestic factors which
I
led
can't
to
hear
India's
Sharmila.
rally. We know what were the factors out of India which led to the rally? Because we know that China has been under pressure, but there have been some significant growth in India, a steady GDP, and domestic consumption being very positive. Do you think those factors will also sustain the Indian market's growth?
I can't hear you, Sharmila.
Okay, some audio problem.
Avasti, the question that my colleague
clearly,
Sharbila was asking was the domestic factors. There's no doubt about the fact that as a consumption market, that really helps India with
Am I
a
audible?
growth story. What perhaps, in your opinion, is driving India at this point in time, not going beyond the consumption market that we are really looking at?
I think the capital formation is something that is going to finally kick in. Private capex is the one big absent thing that we have been waiting for quite some time now. I think gradually that private capex, the animal spirits as we call it, are coming back into place. The consumption demand that slowed down considerably after COVID is normally coming back. And I think there are consumer shifts. And the other thing is the tier 2, tier 3 cities, the urbanization, the rising per capita income. These are the broader trends that will drive India into a different zone. And for the equity markets, perfectly, I think it is the way the domestic market has developed, which China seems to be lacking. Domestic participation is very strong. If you look at right now, US is one of the biggest FPI countries that we have, and the domestic mutual fund industry is more or less equivalent to that. So I think most of the outflows that come in occasionally from the FII side, which we were earlier very in a problematic situation to handle those kind of outflows. Now with the SIP inflows at 15,000 crore a month, I think we have a strong base AUM from the domestic investors. That is largely driving and supporting the Indian markets. And obviously the comparative growth rates, if you look at, I think we will be in a sweet spot of growth over the next 3 to 4 years also. So domestic investments, comparative valuations, comparative positioning, everything puts India in a very sweet spot. Add to that the demographic advantages. So I think long-term India remains a very sweet spot. And the government policies, the way if you look at how defense has grown over the last 3, 4 years, I mean, 5 years ago, if you spoke about defense being having export capabilities, we would not have thought about it. Now, over the next 5 years, I think semiconductors or things like this could come in and play a very pivotal role in the way India is perceived globally, and also how we grow in terms of domestic growth rates as well.
Yeah, Sharad, it's a very happy time for investors. India emerging as one of the key players among the emerging markets. Now, for those who are invested, it's very interesting to learn from you, Sharad, whether there are some scope for some sectors to correct themselves even when there is a rally, and what are the emerging pockets to your mind?
Yeah, I think there are always opportunities that some sectors could correct, like some of the broking company stocks, some of the index-based stocks, they have rallied to abnormal valuations. Unless and until something very positive happens with the numbers, for them to continue with that kind of run-up would be difficult. So within the market, you always have pockets which occasionally get overvalued to bizarre levels, and then they correct over a period of time. Some of the railway stocks, if you look at them, the way they have rallied over the last few days, that's pretty abnormal. I think they are discounting 3.5, 4 years in advance. For some of the defense stocks, that could be true as well. While some of the chemical names may be something that has not been looked at by the markets totally. So there could be a turnaround, particularly on the agrichem side, you could have a very big rally as numbers improve over the next 2, 3 quarters. And I think consumer durables is one theme which I'm looking at very positively. I think the way the bond inclusion happens later this year, that could substantially change the view on the Indian currency as well. I think that is one thing that has not really strengthened over the last decade or so. But now I think gradually that should turn, and we should be in for a period where the rupee would continuously appreciate against the US dollar as the bond index flows start, say, in the second half. So we are very bullish. I think for consumer durables, it could be a very sweet spot time over the next, say, 1.5, 2 years, because oil prices will be stable to lower, and the imports would be cheaper because of the currency appreciating. So I think consumer durables is one space we like. We think there could be a lot of improvement in the numbers going forward.
Thank you so much, Sharad.
Well, thank you very much,
Thank you
Mr.
so much,
Awasthi
Sharad.
and Sharbala, for joining us on this broadcast. In fact, there was a point in time when perhaps the foreign investors were enamored by the China story, but there is a massive turnaround that's taking place.